Hello, this is David Skrika, and trying kind of a new version here of Technical Rap. I got a program called Camtasia, which allows you to basically capture what's on your computer screen. So it's actually not recording the PowerPoint, it's just recording the screen and me talking. So we're going to, use this, and hopefully it works out. And this is a much better way than doing the podcast with the PDFs to actually do the audio and the video all in one. So please tell me if you like it or not. I got a few things in here. The files are a little bigger this way, but what I can actually do is upload them to YouTube or a third-party server and then put the link on the site, and I can put into an account protected site on YouTube where you can watch them. Okay, so this is Dave Skrika here, and we have our technical rap right here, and so we're going to get going into it right now. So the first chart we have, we've recently been big on this Irish kind of bank trade, and I think this is a kind of a maximum pessimism trade where things have totally collapsed. You can see this is Allied Irish Bank, which has a huge debt problem, and the stock has actually fallen 80% since just the beginning of the year, and is over 98% off its low. Now, the only way I think we can lose money in this trade is essentially if these go to zero and are nationalized and go bankrupt or whatever. But I don't think it's going to happen because I think they're just basically going to bail them out. So that we can see here, and basically you can see it's just oversold. It's totally beat up, and it's probably the time to kind of trade it or buy it down here. And of course, this has led to weakness in the euro, and we can see that the euro, after going to almost 143 in early November, not even a month later now, is under one. It's at 129 or 130, and I think this is kind of ridiculous. These swings we're seeing back and forth in the currency markets, like you can't tell me that the euro went over from 127 to 142 and then back down to 129. And this is rational, because it's not. What it really is, there's all this money flushed around looking for trades, and there was this anti-dollar trade going on a month ago, and now that's kind of all got sucked out. So we've seen essentially the euro down, basically straight down for the last 5-6 trading days, and it seems to me that a lot of the guys and hedge funds who are long the euro or short the dollar are now kind of getting washed out. And I think the problem with the dollar and the euro is they're the two largest currencies in the world, but they're also maybe the two worst. So what you're seeing is gold is still at 1380. Commodity, the CCI, is still very high. We're seeing that all this printing of money and bailouts is actually creating inflation. Forget about the bogus the CPI numbers and core rates and all the. I'm not a conspiracy theorist, but all the basically lies that the government tells you, because we all know that there's inflation. We all know prices are going up. And, I love how the guys who argue for deflation talk about the core rate of CPI going down. Well, the problem you get is that someone who's realistic looks at it and has to pay higher insurance bills and higher education bills and higher healthcare bills or whatever. They all know that's just a bunch of nonsense. So, this is all inflationary. So what we're seeing is hard assets going up against everything, going up against the yen, going up against Canadian dollar, going up against the euro and dollar especially. So in my book, The Great Super Cycle, I talk about the dollar maybe going down to 40 on the dollar index. I don't know if that's going to happen because the euro is such a terrible currency and it's the largest weighting in the dollar index. But one thing I could definitely see is that you get in this trading range in the euro of, say, $1.20 to $1.50, and it flops around in that range, and within the confines of that range, guess what happens? The euro goes higher, the commodities and gold go higher. So this is gold right here. We can see, I think we've built a very, very nice base in the 1315 to 1330 area, the lows of October and November, and now look like we're coming up through this base. Everyone was talking about this head and shoulders top at 1380, and we took that out, and we go through 1387.10, which was the high in October, really take it out. I really am not a big fan of all those technical patterns, because I believe that those patterns are only, apparent after the fact, that if you don't break the head and shoulders, then the head and shoulders is there. But if you do break it, then it's just a bunch of nonsense. So we did pull back to the 50-day moving average. We could still pull back to the 150-day moving average, which, considering it's sloping upwards, will probably end up being like 1,300. But I don't really see a huge amount of downside for gold here. The mid-November timeframe is the seasonal weak period of the year, which we've now taken out to the downside. We've already seen that. Now we're starting to move higher. From the MACD above, we can see it looks like we've kind of maybe stopped the downward momentum, and we're going to start turning higher. So I actually don't want to be too bullish, blindly bullish, but I think we're ready to go. And I think one problem was too many people got short on this little move. Guys like Doug Cass and a couple other guys I know who know nothing about the gold market were essentially shorting it on this move down. And I thought that was a real sign there was limited downside in this move. This is the HUI, which had a nice reversal on Monday. And then again was a little bit, was basically flat at the open, a little bit lower, and again finishing up over 7 points. And actually was up nearly 12 or 13 points at one point. But what happened is the stock market sold off at the end of the day and hit the gold stocks a bit. And same thing as with gold. It looks like a very, very nice base in this kind of 525 to 530 area has been formed. We had a nice reversal the other day. And I think there's a better chance that we start challenging those highs of October than pulling back to 450. Again, I have to be open, and maybe we do go back down to 150-day moving average, which, considering it's sloping upwards, will end up being about 500. But I think everything is looking good here. The seasonal weakness in November, we saw that, and now we're entering the seasonal very, very strong period. This is Eagle. This is a stock that's looking really good to me. I really like. You can see this kind of like tons of support it has between about 17 and 15. So I definitely think under 1750, under 1775, it looks good here. And we should finally be able to break out of the resistance in the 1920 area when it finally does. And again, the MACD looks really good. We got oversold, and the MACD now looks like it's about to turn up. Same with the stochastic, which is now coming out of the oversold area. This is the 10-year Treasury, and I really find this interesting. We all know that the worries over the pigs. Italian bonds have begun to sell off. Spanish bonds have begun to sell off, and the like. And what's interesting is the 10-year note in the United States has also begun to sell off. And not sell off, it's up from its highs of October, or lows in yield. But what's interesting is look at the most recent rally with the sell-off in the market. We were at about 296 in mid-November, and now we're only at about 280. So we've seen barely even a move lower in yields, higher in the bond, despite this sell-off in the stock market and all these worries from Europe. So I think this is a sign that the bond is really, really, really starting to weaken, and that these crises aren't having the effect they once did in terms of the flight to quality to the bond. We kind of have this big basing pattern in the yield from about 3 to about 240. So if we take out 3 to the upside, I think we might be really seeing that significantly higher. And then the U.S. bond market following the lead of the Spanish bond market, and Italian bond market, and Irish bond market. And this is a way to play it. I would look at shorting or maybe buying some put options on the CMF, which is the iShares California Municipal Bond. I think that one of the next crises no one's talking about is the crises in munis. And one problem I see is I think the Fed might monetize this as well. But we saw the big sell-off and falling off a cliff in November. Now we've seen the kind of snapback rally. Basically went from 110 to 100, and now we're back to about 105. So we've taken about 40% of we fell 9 points, or we've rallied back with just over 4. So we've taken 40 to 50% back. So I think that we might top here and then might see the next move lower. So basically, to end off here, I think that the bonds look like they're moving lower. And we're seeing this snapback in the dollar and the euro selling off, but I think we're near the end of that. I was looking for low 130s, and we're about 129 to 130. So it could still go down a couple points, but at the very least, we're due for a short-term pullback or bounce back. And I think the problem again is everyone's looking at these sovereign countries like Portugal and Ireland and Greece and blowing it out of proportion because they're all very, very small countries. Now, Spain does bring some worries because Spain is a major economy. But again, you look at what's going on in the United States, like Portugal or Ireland going under is like Alabama going under. And the United States would not fall apart if Alabama went bankrupt. So I think that's the way we have to look at it. And of course, like a place like California where the municipal bonds are starting to fall out, that's really, really dangerous because, that's one of the largest economies in the world. California, if it was a sovereign nation, would be like the 6th largest economy in the world. So I think that is why my argument that the euro is not going to go below 120 by very much, or even definitely not below 110 or 1-to-1, because the problems in the U.S. are just as big. So probably what's going to continue to happen is they're going to be in this wide range, a lot of volatility, and then within this range, we're going to see commodity prices go up against all of them as they create inflation through money printing to bail out all these banks and whatnot. So it's David Skrika signing off. I hope you like this new version of Technical Rap, and I'll talk to you later. Bye.